Okay guys, in this video I'm going to give you a New York Forex scalping strategy, and this model is a reversal strategy and you can capture a massive move in New York if you can time this right, and I'm going to show you exactly how to time this right. Okay, and the first thing you're going to do, and New York is 7 till 10 a.m. by the way, it's 7 till 10 a.m. Eastern, so you've got 3 hours. And what you want to do is you want to wait and you want to watch for some sort of key liquidity to be taken, because for this model, because it's a scalping model, first of all we don't need daily bias, so we don't need higher time frame analysis. And what we're looking for is we're looking for key liquidity to be taken out. So it's right here, right here is 7 a.m. We get a little fake move, and we can see that we're rallying up, right? And I hope it's pretty obvious that we're going for this liquidity here. This key liquidity here we're going for. So we're gonna mark this out, right? And the moment New York takes out this liquidity, right? So it does it about 9:30 a.m. And reversals in New York are great towards the end of New York session. And here's a gold mine right here, right? Literally because I'm gold. After around 8:30, start looking for reversals, because the first, hour and a half, 7 till 8:30, it's usually going to go with the trend of London. But once the key liquidity has been taken out, which is this high here, once this high is taken out, so this is previous day's high, once this key liquidity is taken out, we're looking for any sort of reversal, right? So we're going to make this a bit bigger. We're looking for bearish fair value gap to form, right? Because we see price instantly wicks in the other direction. It instantly reverses in the other direction, right? And at this point here, we're looking for a big bearish fair value gap, because we want to see that smart money has gone up here just to take out orders, right? We've gone here just to take out liquidity, and we want to quickly reverse in the opposite direction, because what we really want to do is we want to capture a large move, right? A large move with a good risk reward ratio, and New York always does that, right? So we've taken out the key liquidity, we've got a big fair value gap right here, big fair value gap like that. And what you're going to do is you're going to enter on the fair value gap. Now you can enter right here like this, right? But your stop loss is quite large. Stop loss is quite large, and because the fair value gap's kind of big, you can enter around the 50% level. And if you want to be really, really precise, you can just get the Fibonacci and just measure the 50% level of the fair value gap, right? Doesn't really matter, but it's around here, and price will almost always go to this 50% level. And if you enter the 50% level and you're scalping, you can get a massive risk reward ratio. So we've just reduced our risk by half, right? We've reduced it by half, and we're going to target at least this low here, right? At least this low here, or even this low here. So we're going to get at least a 3-to-1. A nice easy scalp in New York. A nice easy scalp in New York, and this presents itself all the time, right? Because what we're looking for is, forget daily bias, forget higher time frame. We're just looking to scalp. We're looking for quick, easy moves, and what we're doing is we're waiting for key liquidity to be taken out. As soon as this key liquidity is taken out, we're looking for a strong fair value gap in the opposite direction, because that fair value gap is smart money telling you there's a reversal. If there's no fair value gap, don't trade. Because someone was asking me this in the comments. If there's no fair value gap, don't trade. But a big fair value gap is smart money literally screaming at you that we're bearish. And the only reason price comes back to this fair value gap, so let's mark this out. The only reason, right, as the price come down, it goes to this fair value gap, is just to give smart money another opportunity to short, right? Another opportunity to short, and it goes straight down. Because some people, they do like a turtle soup strategy, which is as soon as price takes out this high, they're selling into that, which that's a lot more advanced and a lot more risky. So I personally wouldn't do that. But wait for a fair value gap, and you've got an easy trade, an easy high probability trade. I'm telling you, this strategy is a money maker. It's such a money maker, because everybody knows, right, that New York, characteristically it continues London's trend. But there's so many little like liquidity sweeps, and if you want to capture a big move in New York, a real big move, is you want the reversal. You want the reversal. You want to watch the key liquidity taken out, fair value gap, enter on it, bam. There's your free risk reward ratio, nice and easy. Right, and again, and this is the previous day, right? So this is the key high that we are talking about. But let's just go on this day, right? So this is the fresh New York session. Right here is London's high. Right here is London's high. So we're waiting for this key liquidity to be taken out. This key liquidity, and New York is around 7 a.m. here, right? So we're not really looking at the charts. We're not really too interested until around 8:30. And if you look at 8:30, we get this move. We take out liquidity. We take out this key liquidity, London's high, and then bam, we instantly move in the opposite direction. I mean, just look at these candles, right? Look at how aggressively we move in the other direction, and look at what we get. And this is what I'm telling you about these great risk to rewards. You see this fair value gap here? Let me mark this out for you. See this fair value gap? Like that, right? You enter on this fair value gap here, you're going to make a lot of money. So stop loss at this high. If you really, really want to be aggressive, it could be at this candle. This candle's high because it forms fair value gap. So if you really wanted to be aggressive, you could do that. But let's just be like harsh on yourself, right? Let's just say Your stop loss is there. You're going to target at least this low here, right? At least this low here, 3 to 1, or even London's low, which just about get it, right? Just about get it with spread for a 4 to 1, right? 4 to 1, like that, right? That's what you can do. And if you really, really wanted to be crazy, if you wanted to put your stop loss right at this fair value gap high, and I'm not saying you should do this. I mean, you get a ridiculous 6.5, and this is fairly high probability because let's be honest. It's very unlikely that price is going to go above this fair value gap. Do you know what I mean? So if price has massively gone down, very unlikely that we're going to go up to this wick and then come straight back down. Right? It's very unlikely that price is going to do that. Right? If price does go down and then comes right up past this stop loss, it's likely it's going to take out the high anyway. So you'd be wrong. So you could do that, enter the fair value gap, and then have your stop there. That's quite aggressive. But if you really, let's say I don't know, let's say you want to pass a prop firm challenge or whatever, you could easily do this because, I mean, look at this 6.5 risk to reward, and then let's say you traded the next day, right? The next day we wait for the sweep. You could just aim for like a 1 to 1 really with like 2% risk and easily like pass your prop firm in 2 days. 2 days, that easy. And yeah, this is a great model. It works on gold, it works on yen, it works on GBP, USD. It wasn't all forex pairs, and definitely try this out. This is a money maker. And if you enjoyed this video, like, subscribe, leave a comment for the algorithm, and let me know what video you want me to cover next. And I'll see you guys in the next video. Peace.